Hello and welcome to Zoom Out with TouTzuSays. I'm your host, Robin Lin, and this is my Q3 2023 market recap. Before we get started, of course, disclaimer, this is only for your entertainment. This is not investment advice. I'm biased, I have blind spots. Use your own brains. This first slide, I'd like to show you an interesting chart. The orange is the Magnificent Seven, the top seven stocks in the S&P 500, which make up the FANGs, NVIDIA, Apple, et cetera, et cetera. So that went up from 0 to 81%. If you took out the top seven, the S&P 500 would have only done about 10%, 11%. And so that is kind of what has happened through the year. It's seven stocks that have carried the entire stock market. In this slide, I wanted to show you something about unemployment. What's been really interesting is the initial jobless claims, which happen every week. They take a poll of all the numbers of every state that have new filings for jobless claims. The jobless claims have been extremely low for this period in the last year or so, which is very strange. And the unemployment rate has actually fallen back down to 3.7%, despite our economic slowdowns, concerns for a recession, et cetera, et cetera. It's very confusing for a lot of people. I'd like to highlight, though, the dark blue line. This is the line of what they call the warn notices. Those are notices that large companies with at least 100 employees, if they plan to fire employees, they must file this notice 60 days ahead with the government, with the state governments. So when you see the spike increasing, that means these layoffs are coming soon. Now, what is even more interesting is the most recent chart I've seen on the Warren data. It has a massive spike and then a massive drop this last month. I don't know what that means, but one data item doesn't give you a full trend. We need to watch how this goes. But I would suspect that this little spike at the beginning still means job losses in a couple months, and maybe after that the layoff planning is decreasing. Inflation is the big deal. We all feel it in our daily lives. It slows the economy. It also forces the Fed to react by adjusting interest rates. So we definitely had this spike last year up to 9% inflation, and it has definitely come down. However, headline inflation, which includes energy and food and things like that, we've been seeing a spike back up over the last 3 months. So it's now around 3.7. Where does that trend go? I suspect that at least energy prices and service prices continue to rise, and I don't think that this is going to go away quickly. So the ultimate trend is still higher and sticky inflation in my mind. Core CPI is similar to the headline, except they take out all the energy and food. So core CPI is actually the measure that the Fed technically uses. However, it still is at 4.1%, and it hasn't been below 4%, and the Fed basically targets 2%. So it's likely that they will remain tight and restrictive. Maybe they won't raise interest rates further as the market is reacting to higher interest rates. However, it doesn't feel like they want to let off the brake or pump the gas anytime soon. In relation to the higher interest rates from the Fed, it affects the Treasury bond markets. And what's been really interesting is when the federal government, when the Treasury needs money, they need to borrow money. And they borrow money by selling US Treasury bonds. Unfortunately, because of how things evolved this year, we have a massive mountain of Treasury bonds that are going on sale, that have been on sale. And when the supply of Treasury bonds outpaces the demand of Treasury bonds, we see yields, Treasury bond yields start to rise. So we haven't seen yields rise like this in a long, long time. The 30-year is now above 5%. the 10-year, which is a very critical measure in the financial world, is just around 5%. And that also forces mortgage rates to go up in tandem. So mortgage rates are now around 8%, which is a very far cry from 2 years ago of, say, 3.5% or 4%. Now, what does this mean for the economy? This is a great question. On many measures, the NBER, I think this is the National Bureau of Economic Research, they are the actual arbiters of recession or no recession. And according to the main measurements that they track, it doesn't really look like we're in a recessionary situation. In fact, the non-farm payrolls, the unemployment rates are extremely healthy. It doesn't look like a recession. And a lot of the other consumption and spending and GDP numbers look okay. Nothing like the downward spike like we had in 2021. On the flip side, the leading indicators for economic trends, that has been going down consistently for 18 straight months. And as you see down here on the bottom right, it's below the red line and it's been there for a while. In the past, when it hits the red line and goes down significantly, we tend to have a recession. So there's no doubt there's slowdown coming ahead. Will it put us into recession or not? That's another factor. But regardless, the slowdown is still coming and may still come more. These three charts, are a little bit of a hint of consumer spending. So we've been hearing, yeah, unemployment rate maybe is climbing. We're seeing that people who didn't have to pay the student loans, they had a few years where they could just temporarily not pay. Well, that's restarting. So they're going to have to start paying back their $1 trillion of student loans in little increments. I think that gas prices, food prices, inflation in the economy has been rising, so that's become a burden for a lot of Americans. And also, because interest rates rose, credit card interest rates have also risen in tandem. So you're seeing charts of consumers spending a little bit less on their credit cards. You're seeing that the debt they have to pay on that it's up to like ultimate highs around the 20% range. Yet, consumer spending over the last month or so hasn't been bad. And over here on the top left, this gold line, 2023, we actually around Labor Day actually had very healthy spending. And it looks like that spending might continue, at least for this month and maybe into next month. This chart with the bar charts over here is a breakdown of spending by wealth category. So if you make less than $50,000 a year, your spending levels have been decreasing over the last few years. If you make more than that in the middle class, it has decreased, but not terribly. And if you're in the upper bracket here, you're spending about as much as you spent before. Okay, so if there's excess savings in the upper echelon segments, consumer spending could be relatively okay for the rest of the season. Having said that, in the macro, household spending is likely still to decline because all the excess savings that we had built up through COVID and all the money that the government spurred around, we're winding that down, and that's going to go down to zero by the beginning of next year. So the excess savings that we used to have as a buffer for spending, that is definitely eroding and going away. These two charts I find really important. The top chart is about small businesses and the bottom chart are for larger corporates. Either way, bankruptcies have been climbing and rising rapidly compared to the years before. And so this is a true warning. I think other chart that I have shows that even in the S&P 500, almost 50% of the companies listed, public companies listed, are actually not profitable. And when you're not profitable, and if you happen to have loans that are due and you need to refinance, well, now you have to refinance at a much, much higher interest rate. And so not only is it harder to get refinancing in a slowing economy, but also you have to pay a lot more for it. So that has become more and more difficult. And what you're seeing is these bankruptcies are essentially the sales are not enough. And if they had debt, that reset at higher rates, they're having to pay much higher rates, so they must have higher revenue in order to cover that. And if that doesn't work out, they go bankrupt. Here is a chart specifically for the larger corporations in the S&P 500, where you see all the debt, the dark blue, that is maturing in that year. So, for example, Apple borrowed, $10 billion in the market for 2 years. Oh, well, maybe it's coming due in 2024. It'll show up in this bar. What's important to note is for the dark bars, the biggest hurdle is actually in 2025, but that hurdle for those next 3 years is quite substantial. And for the Russell 2000, which is a small cap index for the smaller companies in the US, they have a massive spike definitely in 2025, 26, 27, 28. There's a mountain of debt that they need to refinance over the next 5 years. And if the economy doesn't recover, if their sales don't recover, they're at higher risk of going bankrupt. Geopolitically, obviously, we know that there is now a war going on in the Middle East, in Israel, between Hamas and Israel. What's interesting to note here is obviously when that happened, oil prices down here spiked immediately, even though Israel doesn't really produce oil or natural gas, and it doesn't have pipelines that traverse its territory. However, everybody is quite worried about this spreading to other territories and possibly even throughout the Middle East. I wanted to highlight, I made a video talking about the war in Israel. Just a few thoughts for you to consider, that Jordan and Egypt are not throwing their gates wide open to welcome all the Palestinians. And there's a reason for that. This region is very complicated. It has a long history of alliances and shifting alliances. It's not so easy just to say this or that. It's really very complicated, and it requires a very circumspect approach to understanding how things are going here. Suffice it to say, right now, Lebanon, which houses a right-wing faction called Hezbollah, which is supported by Iran, they have been doing lots of missile throwing over the border to disrupt things in Israel. They've even, I think, sent a couple of missiles towards the ocean, towards the U.S. Fleet in that area. In the meantime, in the Gaza Strip down here, the Egyptians are, I believe, getting ready for their ground assault, and they're making preparations to basically try to wipe out Hamas. It'll be very interesting. President Biden just flew through. I think he gave the message of be careful, don't make the same mistakes that we did in 9/11. Try to limit civilian casualties, and remember that the world stage is still watching. Obviously, they want to play it in a way that doesn't inflame even more reactionary sentiment in the Middle East against Israel. Meanwhile, in other parts of the world, this top part over here, Sweden said their submarine cable, their internet cable, one of their major ones, was suddenly cut. It has been damaged, and it's highly likely that the Russians did it because they probably did the last one as well. In the Philippines, there's a little area where the Filipino fishermen and the Chinese Coast Guard are having territorial spats. The Chinese Coast Guard, with their big ships and water cannons, have been extremely aggressive, but feisty Philippines have been fighting back. And of course, because the U.S. has now been approved for 4 new bases in the Philippines, this was signed with the new president in the Philippines, Marcos Jr. This is becoming a very dangerous hotspot as the U.S. has security agreements with the Philippines as well. Obviously, in the Gaza and Hamas, the Gaza and Israel war, there are now 2 battle carriers from the United States in the region to support the thing. This is a strong show of force, but it also is very dangerous when you have military activities so close to each other. Accidents happen. Down here we have Finland and Estonia where they have a pipeline, I believe, was attacked. Again, they suspect the Russians right now. So there's a lot of stuff going on around the world that everybody needs to pay attention to. Let's not also forget that we still have El Nino to deal with. We're seeing some major drought conditions in Brazil right now, which has been one of the biggest exporters of corn and soybeans and that the Chinese have been buying. We're having abnormal weather conditions all over the world. And so it remains to be seen how that affects true agricultural production, but it is likely that, at least in the US, we're going to see some less cold weather in the West and the Central America, center of America, possibly a little bit drier. And that could definitely affect how our agricultural production will turn out in next spring. Finally, I wanted to leave with this quick slide. This was produced by JP Morgan, but this is kind of confirming pretty much what all the research, all the different people that I follow on energy and oil, this chart is really just saying that the demand for oil is not likely to go down much, if at all. In fact, maybe even goes up over the next 5 years, whereas production estimates have been going down. So there is this gap of production, which only means if this gap is not filled, we're going to be short of energy, and that means the prices are going up. Now, OPEC has come out with a study and said they need to see $14 trillion of investments in order to ramp up production to keep this from being such a big gap. We'll see how that plays out. However, there are really good indications that, I mean, there's just no storage of oil anywhere. The United States, we have the strategic petroleum reserve. It used to be 90 days, it's down to 17 days worth of oil. The US does produce a lot of oil, shale oil, and this year actually record production, but the number of rigs have been going down. The oil companies are not eager to spend billions of dollars to go and open more rigs, and the policy of the United States and a lot of the Europeans are very negative towards fossil fuels. So it's a very difficult environment for investment for the long term. And most energy companies are incentivized to just have the production go down. If the demand goes up, they're just going to make more money. So this is a very tricky situation. Does not help for inflation. Okay. And so here's my crystal ball for the rest of the year. I think the economy is going to slow significantly into a stagflation or a shallow recession by the second half of next year. Unemployment should rise, consumer spending should continue to weak and may be even weak all the way into 2025. I think inflation remains sticky and high, up around the 4% range. And I believe this forces the Fed to keep the interest rates at a high level. They won't be cutting interest rates in a hurry unless something severely bad happens and the treasury market breaks. Overall, higher interest rates causes animal spirits to die out. And especially in industries and sectors that are highly leveraged, like real estate, the higher interest rates are going to significantly slow those areas. I believe that'll happen in real estate and certain sectors in the corporate environment. Geopolitically, I think tensions are going to continue to rise. This was the horrible predictions we made several years ago about deglobalization and causing of inflation. I don't think we're going to avoid that path. I think that will continue on for quite some time, whether that's the Ukraine war, the war in Iran, Israel, maybe that spreads out or takes a lot longer. And then we still have to worry about Taiwan and China. The El Nino weather plus energy uncertainties, it just could mean that there's higher energy demand than expected. And as we mentioned, supply and production there's no investment in this sector. So those trends are moving downwards. And then there are a lot of unintended consequences when you have two active kinetic wars. And like I said, when you have military people in the same vicinity, accidents happen. So things that you don't want to escalate, suddenly something happens and you're forced to escalate, whether that's to defend an ally, or if you're two planes that are up in the air or two ships in the South China Seas bump into each other. Yikes, we don't know how that looks, and it depends very much on the players involved in the theater. So we have to really be cognizant of the risks of surprise war escalations all around the world. Despite these uncertainties and conflicts, I think the US market actually remains fairly resilient. And these are a couple of reasons. I think, for one, when the world is not doing well, is scared, the US dollar tends to strengthen. It tends to do well. It is still considered the safe haven asset. And because of the dollar being strong, that means the assets that are based in US dollars also remain attractive relative to a lot of international options. And finally, as long as net liquidity remains positive. So this is the secret QE-like liquidity that the central banks pump in and prepare for us and for the markets. If that remains relatively positive or at least flat, then risk assets remain interesting and resilient. So we're going to be we're going to really be focusing on liquidity over the next year to see when it wants to spike or contract. And that will be a great tell for us to know how to invest going forward. All right, just remember, don't panic. You have some ideas of how to prepare. If you have any questions or thoughts, feel free to reach out to me here, and good luck and happy trading.